Unfortunately, retirement really is just this simple. 5 things to retire well, to retire comfortably, to retire confidently in a way that will ensure you don't run out of money. After building retirement plans for hundreds of people, I can tell you that the plans that worked came down to these 5 things, not the balance, not the income that supported it, these 5 things. You miss one of them, the whole thing gets harder. You get all 5 right, and everything else kind of starts to take care of itself. In this video, I'm going to walk through all 5 of these items. And if at any point you want to see how these apply to your own situation, there's a link in the description. You can book a call with my team. We look at these things every day. Let's get into it. The first principle is knowing what our real number is, okay? Most people focus on the balance of their retirement savings. They focus on how large that number needs to be before they should feel comfortable and confident quitting their job, stepping into retirement, and living off of those savings. Well, we need to focus on the number, but that's the wrong number to focus on. And instead, what we really need to have our eyes on is the income gap once you stop working. The income gap is the real number, and it's different than your portfolio balance. Your portfolio balance simply tells you how much assets you have to support your retirement. The income gap tells you what your portfolio needs to do for you, regardless of how large it is. More specifically, if you take your monthly spending needs and subtract out any guaranteed income coming in, that's your income gap. That's the amount that your portfolio needs to support on a monthly basis. So if you're someone who wants to spend $10,000 per month in retirement, or at least that's your best projection of it, and you have Social Security benefits coming in of, let's say, $3,500 per month and a pension of $1,000 a month, well, you have $4,500 per month in guaranteed income, meaning your gap is $5,500 a month. That's what your portfolio needs to support. Now, what a lot of people would do would be to take that $10,000 per month spending target, multiply it by 12 to get an annual spending need of $120,000 a year, and then use something like the 4% rule to determine how large their portfolio needs to be. So if you take $120,000 a year, you divide it by 0.04, it's the same as multiplying by 25. I get exactly $3 million. So in that method of analysis, your number would theoretically be $3 million. But that's focusing on the wrong input. We need to focus on the income gap. And instead, our income gap after Social Security and the pension is only $5,500 a month or $66,000 a year. And if we use the 4% rule just as a basic rule of thumb for our example today, well, your number works out to only 1.65 million, not 1.5 million, not 2 million, not 3 million, 1.65. Now, I've run into tons and tons of people over the years who never took the time to calculate their own retirement income gap. If you're someone who's a good do-it-yourself or you're on top of this stuff, you may have gone through this exercise already. There's a whole lot of people out there who haven't. And the cost of skipping this part of your whole retirement exercise is that either you oversave, you work longer than you need to, you have a lot of money left over at the end of your own plan, which might be okay, but generally, that means that you could have spent more enjoying your resources. You could have retired earlier, spent more time doing the things that you really cared to do, as opposed to prolonging your career unnecessarily. Or alternatively, not saving enough and risking running out of money or really having to scrape things together in your elderly years. So now you know your real number. The second principle is about protecting it. And this is the step that most people just skip over entirely. The second principle is building a buffer before you need it. Most people jump into this whole retirement planning situation exercise, as we can call it, with the idea that they need to focus on withdrawal rate first. How much can I take out of my accounts without risking that they'll be depleted before I'm dead? Well, that's really the wrong way to look at it. We need to have a buffer in place to protect the majority of your portfolio if bad things happen at an inconvenient time. So the buffer, to be specific, needs to be a pool of really stable, accessible assets that covers at least 2 or 3, sometimes 4 years worth of your living expenses. And the whole idea is that if you have a diversified portfolio of growth assets and stocks and maybe some mid and long dated bonds in the US and non-US and other asset classes around the world, world, perhaps, each of those asset classes is going to have good times and it's going to have bad times. What you want to do with those assets is preserve the long-term growth potential. In other words, buy them low and sell them high. You don't want to have to dip into those assets and sell them just to pay living expenses at a time when the market's depressed. So for that reason, you need to have a buffer or a war chest in place of a few years of living expenses simply just to give your growth assets more time to recover. And this idea gets into the sequence of returns risk. We all know that there's risk in putting assets in stocks. There's risks in the stock markets. We're investing in big corporations, the value of which goes up and down based on economic and other forces, and really the whims of buyers and sellers in the marketplace. At the end of the day, the market is just a voting machine, and the voters are human beings who tend to be irrational creatures. So over time, the markets are going to go up or down, and historically, we'll go through bad periods of the markets every so often, and we should absolutely expect that throughout our retirement, we'll experience at least 2 or 3 bear markets. Now, sequence of returns risk, so if we're expecting a bear market, let's say every 7 years, and we're planning for a 30-year retirement timeline, or let's make it a 35-year retirement timeline to make the math easy. That means that we're going to have 5 bear markets over the course of your retirement. Sequence of returns risk is the risk that you encounter one of those bear markets, those really bad market periods, right after you stop working. And the reason that that's such a risk is, well, if we presume that we know this is going to happen, we just don't know when, which is the right rational way to think about it, I think, that mathematically, it's the hardest to recover from if one of those bad periods happens right after we stop working. You have the longest timeline ahead of you in retirement. You have a whole lot of money at stake, maybe the largest portfolio size you'll ever see throughout your retirement. That's the most sensitive time. And that's when it's most important to have your buffer in place so that you can ride out those bad markets and allow the growth assets in your portfolio to recover after a bad period. Now, I say 2 to 3, sometimes 4 years worth of living expenses in this pool, in this buffer, because the worst bear markets on record haven't lasted more than about 3 years. The only exception to that historically was the Great Depression, and I think you can make a reasonable argument that that was a different era. That was before the Federal Reserve did the same things that it does today. It did exist, but it was in its infancy at that time. It was before we had the SIPC. It was before we have all these capital controls and infrastructure that we have throughout the banking and market system today. So let's go through our example. Remember, we want to spend $10,000 a month. We have $4,500 a month coming in from guaranteed sources. We have an income gap of $5,500 a month, or $66,000 a year. Well, if we want a 3-year buffer, a 3-year war chest, well, we need to have a little bit less than $200,000. If I multiply 66,000 by 3, I get $198,000. That needs to be part of our buffer because it constitutes 3 years worth of that retirement income gap, and in a down market, we could rely on those assets to cover our income gap and pay our expenses without making an adjustment to lifestyle. Now, what should that $198,000 go into? Well, that's the portion of your portfolio you want in shorter term bonds. You can invest in longer term bonds, medium longer term bonds if you want in your portfolio. One could argue that it's a good diversifier to have those positions in your portfolio. Not a ton of them maybe, but some, but at least some of your bond portfolio needs to consist of these shorter term bonds with maturities between 0 and 3 years. So one way to think about it, it would be you could buy 3 CDs, each for $66,000. One CD would be maybe a 1-month CD, you'd have a 1-year CD, and then you'd have a 2-year CD. And the whole idea there is if the market happens to be down, you can rely on that cash to pay your living expenses that are in excess of what your guaranteed income doesn't cover. So in 1 month, the first $66,000 comes free. You put that in your bank account. That covers you for a year without having to touch your longer term assets. 1 year later, the second CD matures, you put that in the bank, and then 2 years later, your third year of living expenses, the CD for that matures. The whole idea is that you have your buffer, your war chest in shorter term bonds to basically tide you over if you have inconvenient or unfortunate timing with your own retirement. So the risk of not doing this, of not having this buffer, let's say that you have that bad market event right after you retire, you don't have a sufficient amount in shorter term bonds. Stock market crashes during a bear market, you're going down at least 20%. Most bear markets are more than that. Let's say that the stock market falls by 30% and you're invested in a whole bunch of index funds. You used to have a stock portfolio of $1 million. Now the stocks are $700,000. Well, if you need to take out $5,500 a month from that portfolio, you're selling the stocks after they've fallen by 30%. And the way that bear markets work is they can last for a couple weeks, they can last for several years. The shortest one on record was in 2020 when COVID was starting to set in and we had this 3-week period where the markets just did terribly. But inevitably, there is an end to the bear market when things start to resolve themselves in the markets in the world. And you absolutely want to remain invested for that point because there's going to be a substantial bounce off the bottom when that happens. I don't know when that's going to be. I don't know when the next bear market is going to be, but that tends to be how the news cycle plays out. So if you don't have a buffer and your $1 million stock portfolio falls to 700 and you have to take money out of those stocks before you experience that rebound, well, you're really shooting yourself in the foot. You want to keep those stock investments for as long as you can so that you can enjoy the rebound before having to dip into them to meet your living expense needs. So the buffer protects your portfolio. The third principle has to do with taking money out of the accounts in the right order because that decision impacts everything else downstream. So the third principle has to do with pulling the money out of the right accounts first. A lot of people doing their own retirement planning will default to a couple of different things. Either A, they'll just start taking money out of the largest of their accounts, or B, they'll figure that, hey, I'm in retirement now, I should be taking money out of my retirement accounts. That's a pretty popular one. In reality, this decision is impactful, and making the wrong one can cost you several hundreds of thousands of dollars over the rest of your retirement. It's almost never explained terribly simply, so I'll try to do that now. So for most people, I'd say maybe 2/3 of the time, the sequence that you want to take money out of your accounts is taxable accounts first, then tax deferred accounts, and then your Roth tax exempt accounts last. The general concept being the Roth and the tax deferred accounts like your 401k and your IRA, those come with tax deferral or exemption features. And you want to utilize the benefits, you want to maximize the benefits of those features as much as you possibly can by depleting your taxable accounts first. The other reason that we do that is with taxable accounts, the taxes that you're going to pay on an annual basis are interest or dividends that accumulate in the account, capital gains, either if you get a capital gains distribution from a fund that you own, or maybe you buy a position here and it goes up in value and you sell it and you've realized a capital gain. Well, in most of those situations, those sources of income are taxed at lower rates than distributions from your IRA are going to be. And that applies to both long-term capital gains and qualified dividends. Interest and short-term capital gains, which typically comprise a smaller portion of portfolio returns, those are taxed at your ordinary income brackets. So right out of the gate, if you have your taxable account, those long-term gains that you're incurring are probably going to be taxed at lower rates. I'm assuming here that you've held those positions for at least 366 days. Once you do it, it goes from a short-term gain to a long-term gain, and that's beneficial over the course of time. So typically you're taking money out of the taxable account first, and once that account is depleted, and only once that account is depleted, is when you move on to the other accounts. Remember, the tax-deferred 401ks and IRAs, the tax-exempt, the Roth IRAs and Roth accounts, we're trying to maximize the tax treatment, the tax benefits of that deferred taxation. So you deplete the taxable account first, and then you move on to the tax-deferred assets next. That's the 401k, the IRA. Well, typically every penny that you take out of those accounts is going to be added as taxable income. There are a couple exceptions to that if you have basis in an account, which is a topic for another day, but we're going to assume that every dollar you take out of those accounts is taxable as income. Typically, what you want to do is take just enough out of those accounts to get to the tax bracket that you want. And it might be the case in your own tax situation that if you're taking $5,500 a month out to meet your retirement income gap, like in our example, you'll find yourself in a tax bracket that's comfortable. But if that's not the case, if taking that amount out of your tax deferred assets pushes you into a higher bracket, then what you want to do is distribute from the deferred accounts up until you hit the tax bracket you're aiming for, and then take the rest out of the tax-exempt Roth accounts that will not add to your income. Again, there are profiles and circumstances where you might want to switch up the order. Typically, this is how it goes. And then finally, once the tax-deferred assets are totally depleted, that's when you move on to the Roth assets, to where every penny that you take out, you're not paying tax on it, as long as you've had the account for 5 years and have checked a couple of other logistical boxes. So the order matters, not to mention the fact that your mandatory distributions only get larger as a portion of your account as you get older. This can create some problems for a lot of people. Our fourth principle is managing your taxes like a business manages its costs. Most people think that when they hit retirement age, taxes just kind of are what they are. You take the money out of the accounts, you use that to pay your bills, and then you just file your tax return at the end of the year, and it kind of is what it is. Well, I will tell you that the tax brackets don't fill themselves. Your retirement income plan can be engineered in a way that reduces lifetime taxation, and the decisions that you make or don't make can have a profound impact over the course of a 20 or 30-year retirement. Often multiple hundreds of thousands or even millions of dollars of differences in tax liability over your entire retirement. Your three main levers here are which account you take money out of first, how much you Roth convert every year, and when you file for Social Security. So for example, if you're using this liquidation sequence we were talking about just a minute ago, and you deplete your taxable brokerage accounts first, well, those distributions are probably going to come at a lower tax rate, a lower amount of taxation than if you take from your tax deferred accounts first. So that means that you're in a lower tax bracket by doing that. You have more room for Roth conversions in the years where you're taking distributions from your taxable accounts. And then finally, if you wait to file for Social Security until you're a few years into your retirement, maybe you're waiting until 67, which for most people these days is pretty close to full retirement age. Maybe you defer later than that, or you can defer all the way up until age 70. That creates some more space for some of these tax planning things like Roth conversions. Those are your three main levers. So in practice, what this looks like is at the beginning of the year, you're probably doing some kind of projection. So let's use our numbers as an example. If you're taking $5,500 a month out of your portfolio, and that's coming from the taxable investment account first, you should do some forecast of what kind of taxation that's going to produce. If you have a taxable investment account based on stocks that you purchased 50 years ago, and now the value of that account is almost exclusively long-term capital gains, well, if you're selling $5,500 a month and bringing that cash into your bank account, you're triggering about $5,500 a month of long-term capital gains. That should be part of your forecast. If you have other savings accounts that produce interest, that should be part of your forecast. If you're collecting a pension of $1,000 a month, that should make its way into your forecast. If you're collecting Social Security already, that also needs to be in there. So the whole idea is at the beginning of the year, you're penciling out what you think your income picture is going to be, and then you weigh it against what that next tax bracket or next Medicare premium surcharge threshold is. And at the end of the year, when you have a little bit more confidence in your tax plan, we like to do this in about the third quarter of the year for our clients, you refresh that projection with new information, you make changes as necessary, and you Roth convert with the room you have remaining up until that next tax bracket. Now, doing this has varying degrees of impact. For some people, it really doesn't move the needle a whole lot because everybody's a little bit different. Our circumstances, our assets and liabilities all look a little bit different. But for others, it really, really rings the bell. And if you do a long multi-decade tax projection, assuming that the tax rates don't change, tough to make an assumption of what tax rates are going to be 10, 20 years down the road. So it's hard to have a whole lot of confidence in this. But if you weigh the path of not going through this exercise versus the path of doing some Roth conversions in the years where your income is low, this tax valley time of your life, it can easily mean multiple hundreds of thousands of dollars of taxes saved, aggregate tax liability saved over a 30-year retirement. It just depends on the circumstances. That fifth principle is to make your Social Security decision last instead of first. Most people make this decision first instead of last. They start putting together their retirement plan, they figure out how much they'll be eligible for in terms of Social Security, and then they'll decide when they want to file for benefits, which dictates the rest of their income gap and their tax planning strategy. Now, when you decide to file for Social Security benefits, has three variables, okay? The first is the monthly benefit that you'll get at different ages. The second is the break-even calculation of when you will recoup the cost of missing out on earlier paychecks by receiving enough larger paychecks. I'll explain that in a second. And then the third is how this impacts the rest of the plan. So the first is the monthly benefit at various ages. As you might know, you can file as early as 62 for benefits based on your own earnings record. For most people, their full retirement age is 67, and then you can delay all the way up until age 70. Well, the amount of benefit that you'll get depends on what's called your primary insurance amount. So the longer you work, the more money you make, the larger your primary insurance amount. If you file on your full retirement age at age 67, you'll be entitled to 100% of that amount. If you file at 62, you'll be entitled to 70% of that amount every month for the rest of your life, and they'll adjust it for inflation along the way. If you wait until 70 to file, they'll pay you as much as 124% of your primary insurance amount. And every month in between those milestones, your benefit goes up or down accordingly. Now, the second variable is the break-even point, right? So how long do I have to live in order to make it worthwhile to defer my Social Security potentially all the way up until age 70? Now, there are a lot of reasons you might want to file early or on full retirement age, depending on your own timing and personal situation. But absent any of those other contingencies, if you live into your mid-80s, if you live beyond age 83, you'll be maximizing the present value of your Social Security benefits by waiting until age 70 to file. Because by that point, if you're filing at 70, you'll have missed out on some checks you could have been collecting along the way. But the checks will be larger when you start getting them. And by age 84, you'll have collected enough of those larger checks, 14 years of those larger checks, and that's the point at which you'll have collected enough of them to outweigh the checks you missed out on by not filing earlier. So the break-even point is relevant. And then the third variable is how this impacts everything else. Obviously, the later you wait to file for Social Security, the longer you'll have a larger retirement income gap. When you file for Social Security, some of those benefits might be taxable income, depending on how much other income you have, and it impacts how much risk you should be taking in your portfolio. If you don't have very much by way of Social Security benefits because you filed earlier and you need to take a substantially greater portion of your accounts out every single year to meet your living expenses, well, that might impact the level of risk you want to take in your portfolio. So this decision impacts everything else. Now, 9 times out of 10, for people who've built the other 4 variables adequately, it really makes more sense to delay filing for Social Security until you're 70. Yes, there's some questions about the status of the Social Security trust. Yes, the balance in the account is being depleted. That's a conversation that we'll cover in another video. But by deferring until 70, if you're in reasonable health and think you're going to live into your mid-80s, not only are you maximizing the present value of your benefits, you're creating more opportunity and a longer tax valley, which you can use for those Roth conversions we talked about earlier to give yourself more flexibility in the future. And if it's not Roth conversions, it's potentially opportunity to harvest long-term capital gains in your taxable brokerage accounts at 0%. It just gives you more flexibility for the first few years of retirement. Filing early can make sense in some circumstances too. Obviously, if your health is not good, you don't think you're going to live until 83 or 84, and you probably want to collect more of these checks as opposed to foregoing them just to wait for a benefit you'll never receive. So that's an obvious one. There are also spousal considerations. Sometimes it makes sense to file early if your spouse's income, if they haven't filed yet, or their income is substantially larger or substantially smaller than yours is. So your spouse's situation impacts yours as well. Another circumstance where it makes sense to file early is if you don't plan on spending a dime of your Social Security benefits, if your intent is to take those checks and reinvest them in the markets, it's not crazy to think that you might be better off taking more checks and investing them because that growth will actually can actually outweigh the benefit of delaying and collecting larger checks later on. But that's only if you're going to take those checks and reinvest them at a reasonable return. If you're going to take those checks and spend them as part of your retirement income plan, that math doesn't quite pencil out. Now, just to give you an example of the differences here, let's say that you have a primary insurance amount of $3,000 per month, which means that if you file at 67, you're getting $3,000 a month. Let's assume that the rate of inflation is its long-term average, 2.56% per year. Well, if you file as early as 62, you're getting 70% of that benefit, or $2,100 a month. If you live to 92, so you're collecting the checks for 30 years, the present value of those checks is $527,000 $1,310. So here's what I want you to take away from all this. Retirement isn't actually all that complicated. Every plan that's worked came down to the same 5 things. Know your number, build your buffer, pull from the right account first, manage your taxes, and then make your Social Security decision last in light of all these items. You don't really need much of anything else. Now, one thing I hear pretty often from people who understand these 5 principles is, okay, I get it. I get the 5 things. I get the 5 principles, but do I have enough money to retire right now? Am I already there? Have I hit my number? Now, if you're watching this, and you're starting to realize that these 5 principles, they're not just simple, but they're connected. The income gap impacts the buffer. The buffer protects the portfolio. The portfolio withdrawals impact your tax strategy. It's all connected. If you have questions about how that impacts you, this is the stuff my team and I look at every single day. There's a link in the description. Feel free to click it, book a call with us. We're happy to talk through your personal situation using your numbers and how each of these 5 components might be connected in your situation. The honest answer is that people are a lot closer than they think when they're asking these questions. I walk through the signs that I look for, the financial, the behavior, the psychological signs in this next video here. If you're wondering about this, I would suggest watching that one next. I'll cue it up here.